Inflation, a word frequently heard in economic discourse, often carries a superficial understanding. It's more than just rising prices, it's a profound systemic shift. Its persistent presence impacts every facet of our financial lives, yet its complexities elude many. Entrusted with the monumental task of economic stability, central banks stand as the primary custodians against inflationary pressures. Their mission is critical, yet often fraught with intricate dilemmas. They navigate a landscape where conventional tools frequently encounter unforeseen obstacles. At its most fundamental, inflation arises from a simple disequilibrium. An excess of currency, combined with a scarcity of available products and services, inevitably drives prices upward. This imbalance underpins the entire inflationary phenomenon. To counteract this, central banks traditionally focus on controlling the money supply circulating within an economy. This forms their frontline defense, aiming to temper demand by regulating liquidity. Their hope is to restore equilibrium. The immediate, tangible impact of inflation is an insidious erosion of wealth. Every dollar earned, every saving accumulated, buys progressively less as prices climb. This reduction in purchasing power strikes at the core of personal financial security. This is particularly evident in the escalating costs of daily necessities. Basic provisions like groceries, fuel, and housing become increasingly expensive, forcing families into agonizing financial choices. Budgets strain, and trade-offs become unavoidable. Beyond the immediate sting of diminished purchasing power, inflation distorts fundamental investment decisions. The uncertainty it creates makes calculating future returns precarious. Long-term strategies are undermined by this persistent volatility. Consequently, both individuals and businesses find long-term financial planning significantly more challenging. Forecasting expenses and revenues becomes a speculative exercise rather than a predictable projection. This hinders growth and capital allocation. Persistent inflation can also fuel speculative bubbles within financial markets, creating an illusion of prosperity. Investors might chase assets perceived as inflation hedges, inflating their values beyond fundamental worth. This often leads to unsustainable market dynamics. These speculative activities contribute substantially to overall instability within the financial system. When these bubbles inevitably burst, they leave behind significant economic damage, impacting a wide array of stakeholders. Central banks primarily utilize interest rates as their main instrument to combat inflation. This is their most potent and frequently deployed tool in the monetary policy arsenal. The aim is to influence borrowing costs across the economy. Raising interest rates is intended to make borrowing more expensive for consumers and businesses alike. This, in turn, is designed to cool economic activity, discouraging investment and spending. The logic is to reduce overall demand. However, this approach is undeniably a blunt instrument, carrying significant, often undesirable trade-offs for the broader economy. Its impact is widespread and not always precisely targeted where needed most. Precision is a luxury rarely afforded. Higher interest rates invariably risk slowing overall economic growth, potentially pushing economies toward contraction. Simultaneously, they can lead to increased unemployment levels as businesses cut back on expansion and hiring. This presents a difficult dilemma. Central bankers therefore face a delicate and difficult balancing act. They must weigh the imperative of controlling inflation against the grave risk of triggering a recession. This constant tension defines their policy challenges. The inherent limitations and potential negative consequences of this interest rate approach are frequently underestimated by observers and sometimes even by policymakers themselves. The wider ramifications can be severe and far-reaching. Globalization introduces an additional layer of complexity to the already intricate task of inflation management. National economies are no longer insulated. They are deeply interconnected. This changes the game entirely. Domestic prices are increasingly influenced by a multitude of international economic factors, from currency fluctuations to geopolitical tensions. Local policies now contend with a global marketplace, diluting their singular impact. This global interconnectedness significantly limits the direct control central banks have over domestic inflation. A central bank can tighten monetary policy, yet imported inflation can still surge, rendering local efforts less effective. Supply chain disruptions, often global in nature, can directly fuel inflationary pressures, regardless of domestic demand. Blockages in one part of the world can propagate price hikes across continents. Recent history provides ample evidence of this. Geopolitical events and fluctuations in commodity prices are significant external shocks that can rapidly escalate inflationary pressures. Wars, natural disasters, or cartel decisions can send prices soaring instantaneously. These are forces of immense scale. These external factors are largely beyond the direct control of central banks, forcing them into a reactive stance. They can only respond to these global tremors, not prevent them, underscoring their limited omnipotence. Surface-level analyses of inflation often focus almost exclusively on monetary policy as the sole determinant. This narrow perspective simplifies a multifaceted problem, overlooking crucial underlying forces. The temptation to find a single cause is strong. This restricted view overlooks the broader economic context, including fiscal policy and underlying structural issues within the economy. Government spending, taxation, and market rigidities all play a critical role. Ignoring these paints an incomplete picture. The reality of inflation is far more nuanced than simplistic monetary explanations suggest. It is a complex interplay of demand, supply, expectations, and external shocks. Attributing it solely to money supply is an oversimplification. Central bankers are human decision-makers, operating with imperfect information and facing real-world constraints. They do not possess perfect foresight or limitless tools. Their decisions are made under pressure, with incomplete data. Their actions are often constrained by political pressures, as elected officials express concerns over economic slowdowns or unemployment. Additionally, prevailing economic realities, such as high national debt, can limit their policy options. The invisible costs of inflation include the erosion of public trust in financial institutions and government. When people see their savings dwindle and prices soar, faith in economic management can diminish profoundly. This trust is hard to rebuild. Finally, inflation can exacerbate wealth inequality, disproportionately affecting different segments of society. Those with fixed incomes or limited assets suffer more, while those with real assets or flexible incomes can sometimes weather or even profit from rising prices. The poor often pay the highest price. The ability of central banks to control inflation is frequently overstated. It is a profoundly multifaceted problem within a complex, interconnected modern economy. Their tools are powerful, but not absolute, against the tide of global forces and inherent economic dynamics.